Okay, this screencast is going to begin with President Herbert Hoover taking office just before the Great Depression will officially begin. So he is elected in 1928, and it's just kind of bad timing because he'll be inaugurated in 1929, and the stock market will crash later that summer, as we'll talk about, or later that fall. So it just kind of right in the beginning of his presidency, there's going to be some trouble. When he was elected, I don't need you to memorize this campaign slogan, but he had run on the campaign that said a chicken in every pot and a car in every garage, kind of implying that there was going to be continued economic prosperity in the country during his presidency, and unfortunately that is not going to be the case. So as we start to discuss the event that jumpstarts the Great Depression, I want to review a few important terms about the stock market, because understanding the stock market is a crucial part of understanding the stock market crash. So many people are investing in the stock market during the 1920s. If you recall from your freshman year economics course, stock is a share of ownership in a company. When you buy stock, you are basically buying a little piece of the pie of that company. You're buying into that company. If the company grows, then your stock grows and your value, your wealth grows. Like, you put only a certain amount in, and as the company grows, you gain money. If the company does poorly and loses its value, then you will lose money. The goal is always, of course, to invest in the stock market as a company is on the rise and to be able to pull your money out with a profit. Companies would sell stock in order for people to make investments in that company, and that company can use that money. So they're selling stock to make money. People are buying stock hoping to make money. So that's kind of the whole premise of buying stock. And if you have any questions about that, you can ask me in class tomorrow. Many people were investing in the stock market during the 1920s, and stock prices rose to an all-time high during the 1920s. So keep in mind, the more people invested, the higher the stock prices would be, because the value of that company rises. Two things were occurring, however, that had a negative impact on the stock market. So people were participating in these two events. You can always pause the screen and just write down the definition that you see, but I'll just continue and go on and explain this. So one thing people were engaging in is called speculation. They were buying stocks and bonds on the chance of a quick profit while ignoring the risks. This means they're kind of buying stock without really doing the prepared research or the needed research to know whether or not it was a smart investment. And this is going to create a lot of risk for people, and they're going to end up losing money that they shouldn't have invested in the first place. So kind of just making impulsive decisions by investing in stock without doing the research is known as speculation. The second practice people are going to begin engaging in is called buying on margin. And this is when people would pay a small percentage of a stock's price as a down payment, and they would borrow the rest. This basically means that they are buying stock on borrowed money or with like credit, which is not effective at all, because you're then basically investing in something with money you don't even have. If you lose that money, then you also now owe the person that you borrowed the money from, or the company you borrowed the money from. Also, if you never pay for that money back, or you never pay back anyone for that money you borrowed, then the stock has like false value, because it says so much money is in it, but that's not even really true. So this is creating kind of a false image for the stock market during this time. Okay, the last thing we're going to talk about in the screencast is the event in which the stock market crashed, and that event is known as Black Tuesday. I don't need you to write down the first two dates. The third date is important, October 29th, 1929. That is Black Tuesday, and that is the date of the official stock market crash. So if you are kind of familiar with how the stock market works, it kind of ebbs and flows. It will increase some days, gain value some days, and then it will drop in value other days, and it just kind of is constantly changing. Well, what happens in the days leading up to Black Tuesday is the stock market goes through several dips where prices and stock values drop, a good amount. They kind of bump back up again, but then they drop again, and they bump back up again. And the more and more little drops that happen in the market started making the investors, the consumers, nervous. And they wanted to basically withdraw their money to make sure that they would not lose the full value of their investment. So you can imagine if you start seeing the prices drop, you'd be very tempted to go quickly sell your stock, withdraw your money while you could, to get it out before it was all loss. The problem is when everyone has that idea together, then you are actually the problem and are responsible for crashing the stock market. And that's what happens on Black Tuesday. Basically, it's a record number of shares sold, and many thousands of people pull their money out of the stock market for less value than they even put it in, because keep in mind, as the price is dropping, that means you're only getting out what it's worth at that moment, so you've already lost money, but you're afraid to lose everything. But by pulling out money at a fast rate, you are causing the crash, and that is when the market bottomed out on Black Tuesday. If you were one of the people who did not pull out your money in time before the market bottomed out, that means you got nothing. So you lost everything you had put in, and that's going to be absolutely devastating. It is estimated that by November 1929, just a few days after Black Tuesday, $30 billion had been lost by investors. And that's not just the companies, that's people's money being put into these companies, into the stock market. That amount of money was lost because of the dramatic crash in prices and the sale of shares. Okay, I went quickly there. Listen to it twice if you need to. Write down any questions you have, and I'm happy to answer any of them for you tomorrow in class. I hope you'll have a good evening.